Well, the Bank of Canada has cut the key lending rate by 25 basis points to 2.5%. Let's get reaction from Frances Donald, Chief Economist with RBC. Thanks for joining us today.
Yeah, thanks for having me.
So you said the inflation situation has not been solved or resolved. Macklem says pressure on core inflation is diminished. What are you taking into your account for your evaluation?
Well, we're taking a look at those core measures of inflation. They've been above 3%. That's quite a distance from the 2% target. Looking at breadth of inflationary pressures, those are still quite large. And inflation expectations amongst businesses in Canada still looks like the job is not done on the inflation front. But what we heard from the Bank of Canada today is they think the risks to that have been diminished relative to where they were a couple months ago. They noticed reciprocal tariffs are no longer in play for Canadians, some pressure on the labor market. Now, I'm still concerned about some of those upside risks for Canada. It has to be watched very carefully. And I think when Governor Macklem and the Bank of Canada today expressed that they weren't actually committing to any further rate cuts just yet, they're also aware that those risks have not dissipated entirely, just in their judgment that they're maybe not as severe as where we were a couple months ago.
Okay, so let's talk about housing, which you say is a mess. Can you explain?
That's one characteristic. Housing is certainly an ongoing challenge for Canadians from a structural perspective. At the same time, there's quite a bit of data that shows a stabilization in housing across the country just in the past couple of months. So that's good news for leading economic indicators of the country and a little less pain happening in the housing sector. Now, that doesn't preclude that we are still in an affordability crisis, that we still have massive surplus of condos in Toronto, an ongoing list of long-term structural issues. But in the short run, a little bit of better news, especially as so far as housing impacts GDP growth. And that's always a different conversation than how are everyday Canadians dealing with housing and the affordability issues associated with it.
How much do you think those retaliatory tariffs being pulled off by Ottawa has sort of helped the Bank of Canada make a decision?
Yeah, I'm not sure that these were as significant a big upside pressure. I think the bigger challenge that the Bank of Canada and all central banks globally are facing is that it's not quite clear how this big tectonic shift of deglobalization and trade wars is going to infiltrate inflation across the entire world. If we disrupt supply chains between US and Europe, it's possible that we see prices rise globally, and there will be implications for Canada for that as well. Now, in the very short term, in the next 6 months, yes, it takes some pressure off. But there's still a risk that we're existing in this stagflationary type of global economic environment, which is trade wars reduce growth and they raise inflation. That makes a job of a central banker awfully hard here. So we prefer to focus on the very big picture. And I think hearing from the Bank of Canada that they're a little bit more short-term thinking right now is a nod to short-term pressures a little bit off, but no dissipation of the long-term factors weighing against inflation and growth.
So, as you know, the bank is not taking into account the federal support that already has been announced. It'll take some time for that to filter through the economy. Have you already started to take that into account, and how much does that change the outlook for the economy?
Well, your feed cut out for a minute there, so I'm going to assume that you asked about the budget and the fiscal amount that's coming through. At least that's the big one that we're thinking about right now. Absolutely, we have to think about how fiscal is going to be impactful for Canada. We know there's a sizable amount of government spending coming on top of what was already pretty large. Markets and economies are second derivative based, so they care about the change relative to where we were. The only problem is that it takes a long time for government money to really start to infiltrate an economy. So we're slightly lifting growth for 2026, but the real impact from this is going to come from where that money is going to go and when it's actually going to hit the economy. We don't want to get too optimistic. We're in a little bit of an air pocket here where the economy is slowing. We know that government help is coming around the corner, but we haven't felt it yet. And if I may add one more point there, the big challenge in Canada right now, growth very, very fragmented. So localized recessions in places like Southwestern Ontario, but other places of the economy doing much better, in fact, re-accelerating. So government money, a much better tool to support those areas that need help now in very specific areas. Monetary policy probably less helpful at curing what ails Southwestern Ontario, for example, and risks some of the inflation that comes from those that easing measures.
Okay, let's talk about the Fed. We get an announcement out of the U.S. in the afternoon today. I'm wondering how differently you see their situation compared to the Canadian.
Well, actually, remarkably, the U.S. economy is firing on different types of cylinders right now. They're facing much more of a stagflationary type of environment. The U.S. had outright job losses in June of this year. Job growth has slowed very, very sharply, and yet inflation looks like it's going to reaccelerate above 3% into year end. Our forecast as high as 3.4%, and that's all those tariffs beginning to weigh on prices for Americans. So this is a Federal Reserve that has clearly indicated they'll also be cutting today. We weren't the only central bank in Canada to do so, and they are clearly explaining to the market that they're going to focus on the job side of their dual mandate. Just a reminder, the Bank of Canada actually has one goal, and that's price stability. The Federal Reserve, with a dual mandate, they need to focus on full employment and price stability. Right now, both sides of their mandate moving in different directions, but they've told us they're more worried about jobs. That's what they're triaging right now.
As we know, the Bank of Canada is going to be watching what happens when those trade talks begin to unwind, when we get CUSMA sort of discussed and whatever comes out of those talks. But what do you think that the bank will be watching for when those talks are underway and when we look forward to a result?
Well, I don't know if the talks are going to unwind. We don't know the direction yet of what CUSMA negotiations will look like. Just a reminder, CUSMA doesn't expire in 2026. That's when the negotiations start. It goes till 2036. And the U.S., very dependent on CUSMA, or USMCA as they call it as well. More trade coming into Canada that's tariff-free because of CUSMA than leaving Canada going to the United States. And as we talked about, that U.S. heading into a slowdown as well. So absolutely, we have to run scenarios. We're doing it at RBC Economics. I'm sure the Bank of Canada is running them as well. If CUSMA changes, how does that impact growth? And that will, of course, have an impact. But right now, we have to go with what we know, which is that we've got big government spending coming in. So far, the trade crisis has been isolated to some areas, very, very impacted. That still matters, not spreading too far beyond. And that inflation is still a little bit hot. So they've got plenty on their menu of things to think about, and CUSMA will become more relevant probably heading into 2026.
Frances Donald, thanks for joining us. Frances is Chief Economist with RBC.